Welcome to another episode of Trends and Ideas. I'm your host, Brian Egley. Summer brings the busy driving season, and it may also bring some potentially lucrative investments in the energy sector. Here to discuss integrated oil and gas companies is S&P Capital IQ equity analyst Michael Kay. Thanks for being here, Mike.
Thanks for having me, Brian.
Mike, you've got a positive fundamental outlook for integrated oil and gas companies. What's driving that outlook?
Yeah, there are several factors right now. First, we think that the production growth outlook is going to start to turn more positive towards the end of 2013. I think there's many projects that are expected to come online over the next several years, and that should drive production growth over the next 5 or so years. Production growth is the main generator of cash flow, so that's our second point, cash flow. These companies are generating a tremendous amount of cash flow, which allows them to fund very aggressive CapEx programs. They're also buying back shares, raising their dividends, and so forth. So there's a lot of flexibility with the cash flow, and the fact that oil prices have remained resilient is helpful as well. Lastly, the balance sheets. These companies have very low debt levels and a ton of cash, significant amount of cash, and that allows for flexibility in terms of operations and maybe strategic M&A and so forth. So we like that, and we like the fact that their conglomerate nature lowers the risk a little bit versus independent upstream or independent downstream companies.
Interesting. It's summertime, we've got a lot of cars on the road. Can you give us an idea of where gas prices might be heading?
Yeah, so prices at the pump are maybe a tad higher than they were last year, despite U.S. Crude oil prices being about 15% higher. Several reasons for this is gasoline inventories are about 9% higher than they were last year, so that's put some downward pressure on prices. There's also a ton of new U.S. crude oil production coming online, so production's up big, and fuel efficiency is increasing as well. So while demand for the summer is likely to rise this year, cars are more efficient, and we do have a lot more product on the market this year than we do last year. So we don't expect gas prices to change very dramatically from where they are now. Maybe pull back a little bit on crude oil prices, but for the most part, we expect them to remain around where they are right now.
All right, we'll see.
Yeah.
Do you have a stock recommendation you can share with us today?
Sure. Let's talk about Chevron. Chevron has outperformed the integrated group over the last several years. Part of this is because of their growth profile. The company is also about 70% of its production is higher margin oil versus the group, which is closer to a 50-50 split between oil and natural gas. So that's very beneficial. A lot of this oil is also linked to higher premium price to oil versus the WTI crude benchmark, so they're getting that benefit as well. Importantly, a big part of the story at Chevron is its position in Asia Pacific. Much of the growth over the next decade for the integrated oils, demand growth anyway, is supposed to come from Asia Pacific, and they are one of the best positioned companies in that area. So we like the cash flow, we like the production outlook, we like the balance sheet, and quite honestly, we think the valuation is attractive as well.
Thank you, Mike.
Thank you.
For more of Mike's stock picks and views on integrated oil and gas companies, we encourage our MarketScope.com subscribers to read a related trends and ideas story on MarketScope Advisor. It's called This Summer, Pay the Oil Patch a Visit. Until next time, thanks for watching or listening. I'm Brian Egley for S&P Capital IQ.